The top 10 best stocks to buy right now in March 2026. Most people spend their entire lives working for money. The wealthiest people in the world spend their lives making money work for them. Right now, in March 2026, there are 10 stocks sitting in the market that represent some of the clearest and most compelling long-term opportunities analysts have seen in years. The market has pulled back, uncertainty is elevated, geopolitical tensions and macroeconomic noise have rattled investors. But history shows that the best time to plant a seed is when the weather looks uncertain. If you are ready to stop watching from the sidelines and start building real, lasting wealth, then pay close attention. What follows is a deep, research-backed breakdown of the 10 best stocks you can buy in the market right now and why each of them deserves a place in your portfolio. Before we dive in, a brief note. This article is for informational and educational purposes only. It is not financial advice. Every investor has a different risk tolerance, financial situation, and investment timeline. Always do your own research and consider speaking with a qualified financial advisor before making any investment decisions. Number 1. NVIDIA. NVIDIA is the undisputed engine of the artificial intelligence revolution. If AI is the electricity of the 21st century, then NVIDIA makes the power plants. The company designs the graphics processing units, known as GPUs, that power everything from large language models to autonomous driving systems. Demand for these chips has been nothing short of extraordinary, and the numbers back that up. In the fourth quarter of fiscal year 2026, which ended in January, NVIDIA reported revenue growth of 73% year over year. That is not a typo. A company generating tens of billions of dollars in quarterly revenue and still growing at nearly 80% annually is almost unheard of at this scale. Next quarter, the company expects growth of approximately 77%. Analysts at Morningstar have described NVIDIA shares as undervalued and called recent concerns about an AI bubble a buying opportunity rather than a warning sign. The bull case for NVIDIA is simple. Every major technology company in the world, from Microsoft to Amazon to Meta, is spending hundreds of billions of dollars building AI infrastructure. NVIDIA sits at the center of every one of those investments. As long as the AI build-out continues, NVIDIA wins. And right now, the AI build-out shows no sign of slowing down. Number 2. Broadcom. Broadcom is the quiet giant of the AI chip world. While NVIDIA gets most of the headlines, Broadcom has been executing a strategy that could see it surpass nearly every competitor in the AI semiconductor space within the next 2 years. In the first quarter of fiscal 2026, Broadcom reported that its AI semiconductor revenue grew 106% year over year to $8.4 billion. That is astonishing growth by any measure. But here is what makes Broadcom truly extraordinary. The company has projected that by the end of 2027, its AI chip revenue alone could exceed $100 billion annually. To put that in context, that would represent a more than tenfold increase from where the company is today. Broadcom has also raised its fair value estimate on Wall Street to $365 per share as analysts increase their AI revenue projections, accounting for new customer deals and accelerating demand. Broadcom is not a flashy company. It does not dominate news cycles or attract the same retail investor attention as some of the more famous names on this list. But for investors who look beneath the surface, Broadcom is arguably the single most compelling AI semiconductor investment available right now outside of NVIDIA itself. Number 3. Microsoft. Microsoft has not traded this cheaply relative to its earnings in years, and that simple fact has attracted the attention of every serious long-term investor on Wall Street. The company's stock has had a difficult start to 2026 after a strong multi-year run, and for patient investors, that difficulty represents opportunity. The core of the bull case for Microsoft is Azure, the company's cloud computing platform. In the second quarter of fiscal year 2026, Azure revenue grew 39% year over year. Microsoft has taken a smart approach to the AI revolution by positioning itself not as a creator of AI models, but as the infrastructure that hosts them. Through its deep partnership with OpenAI and its strategy of welcoming any AI developer onto the Azure platform, Microsoft has turned itself into the landlord of the AI economy. Analysts at Morningstar maintain a fair value estimate of $600 per share for Microsoft and describe it as one of their top stock picks. The company has massive recurring revenue streams, an unmatched enterprise customer base, and the financial firepower to invest aggressively in the technologies that will define the next decade. Number 4. Amazon. Amazon is is a company that does so many things well that investors sometimes forget how remarkable its individual business units really are. At its core today, Amazon is a cloud computing company that also happens to operate the world's largest e-commerce platform, a massive advertising business, a streaming service, a logistics empire, and one of the most advanced AI chip development programs in the world. Amazon Web Services, known as AWS, posted its best quarterly results in over 3 years during the fourth quarter of 2025. The platform has a reported order backlog of approximately $200 billion from customers waiting for additional data center capacity to come online. That backlog alone tells you everything you need to know about the demand environment AWS is operating in. Wall Street analysts project that Amazon could join the exclusive group of companies with a market capitalization of $3 trillion before the end of 2026. Amazon's custom chip business, which allows the company to reduce its dependence on external suppliers like Nvidia, grew at a triple-digit pace in its most recent quarter. For long-term investors, Amazon represents one of the most diversified and durable growth stories in the entire market. Number 5. Meta Platforms. Meta Platforms has quietly become one of the most important AI companies on the planet. What was once primarily a social media business built on advertising has transformed into a technology conglomerate at the forefront of AI research, augmented and virtual reality, and next-generation computing platforms. The company owns 4 of the most widely used applications on Earth: Facebook, Instagram, WhatsApp, and Threads. That advertising moat generates tens of billions of dollars in free cash flow annually, and Meta is plowing that cash into AI research and development at a scale that few companies outside of the hyperscalers can match. Analysts at Morningstar maintain an $850 fair value estimate for Meta, which they describe as a wide moat company, meaning one with durable, sustainable competitive advantages. Meta's stock has pulled back meaningfully from its highs and now trades at a valuation that looks increasingly attractive given its earnings power and growth trajectory. For investors who believe that AI will drive the next generation of advertising technology, consumer experiences, and communication platforms, Meta is a core holding. Number 6. Alphabet. A year ago, investors were worried that Alphabet, the parent company of Google, was falling behind in the AI race. Today, that narrative has almost completely reversed. Alphabet's Gemini AI model has received strong reviews from developers and enterprise customers alike, and the company's tensor processing unit chips are increasingly viewed as a serious competitor to Nvidia's dominance in AI computing hardware. Google's search business remains one of the most powerful and profitable franchises in corporate history, generating revenue and earnings that would be the envy of almost any other company in the world. The company's cloud computing platform, Google Cloud, is growing rapidly and gaining market share, and Alphabet's DeepMind research division continues to produce AI breakthroughs that position the company at the frontier of the technology. Alphabet's valuation has become attractive relative to its peers after a period of underperformance, and Wall Street now broadly views it as a consensus favorite for AI-driven growth. For investors looking for a diversified technology holding with exposure to AI, search, cloud, and hardware, Alphabet checks every box. Number 7. Berkshire Hathaway. In a world of uncertainty, Berkshire Hathaway remains one of the most reliable stores of value in the entire market. The company, now led by CEO Greg Abel following Warren Buffett's retirement at the end of 2025, sits on approximately $373 billion in cash and short-term investments as of the end of last year. That is not just a war chest, it is a weapon. Berkshire's core businesses, including Geco and its other insurance operations, generate enormous amounts of steady cash flow. The company also holds a $310 billion equity portfolio that includes massive positions in Apple, Bank of America, American Express, Chevron, and Coca-Cola. It has recently agreed to acquire Occidental Petroleum's petrochemical unit, OxyChem, for $9.7 billion, demonstrating that the company remains actively deploying capital. Berkshire Hathaway was the first non-technology company in the United States to reach a $1 trillion market capitalization. In a market environment characterized by elevated volatility and macroeconomic uncertainty, Berkshire offers something that very few stocks can: genuine financial resilience combined with compounding long-term growth. Number 8. Taiwan Semiconductor Manufacturing. Taiwan Semiconductor Manufacturing Company, widely known as TSMC is the single most important company in the global technology supply chain that most everyday investors have never heard of. TSMC manufactures the logic chips that go into virtually every major computing device on the planet. Nvidia's GPUs, Apple's processors, and Broadcom's AI semiconductors all run through TSMC's factories. This makes TSMC what analysts describe as a neutral player in the AI chip wars. It does not matter which AI company wins the race for dominance, because TSMC is building the chips for nearly all of them. The company projects that AI-related chip demand will grow at a compound annual rate of nearly 60% from 2024 through 2029. For a company that is already the world's largest semiconductor foundry, that kind of projected growth is remarkable. TSMC's competitive advantage is almost impossible to replicate. Building a state-of-the-art semiconductor fabrication facility requires tens of billions of dollars and years of construction, along with a depth of engineering expertise that only a handful of companies on Earth possess. TSMC's moat is not just deep, it is one of the deepest in the entire global economy. Number 9. Airbnb. Not every compelling stock opportunity in March 2026 lives in the artificial intelligence or semiconductor space. Airbnb has built one of the most genuinely disruptive consumer businesses of the past 2 decades, and the company is still growing. Analysts at The Motley Fool describe Airbnb as one of the few companies that has successfully disrupted an entire industry, reshaping how hundreds of millions of people around the world think about travel and accommodation. Airbnb operates an asset-light business model, meaning it does not own the properties listed on its platform. That gives it enormous scalability and profitability relative to traditional hotel companies, which must carry massive fixed costs on their balance sheets. As travel demand continues to recover and expand globally, Airbnb is positioned to benefit from every booking made by every traveler who prefers a unique local experience over a standard hotel room. The stock has pulled back alongside the broader market in early 2026, creating what analysts view as an attractive entry point for long-term investors. Airbnb's brand recognition, network effects, and asset-light economics make it one of the most durable consumer franchises available in the public markets today. Number 10. Intuitive Surgical. Intuitive Surgical is one of the most overlooked compounders in the stock market. The company designs and manufactures the Da Vinci robotic surgical system, which is used in hospitals around the world for minimally invasive procedures. Once a hospital purchases a Da Vinci system and trains its surgical staff on the technology, switching costs are extremely high. This creates the kind of deeply sticky recurring revenue that long-term investors dream about. As global healthcare systems invest in better surgical outcomes, reduced patient recovery times, and lower rates of surgical complications, robotic surgery adoption is expanding rapidly. Intuitive Surgical benefits from every new system it places in a hospital through recurring revenue from disposable instruments and service contracts, creating a compounding flywheel of growth that builds on itself year after year. The company has a decades-long track record of growing earnings and revenue through all kinds of economic environments, and its moat in the robotic surgery space is formidable. For investors looking for a healthcare holding that can grow independently of the AI hype cycle, Intuitive Surgical is the premier choice available in the market right now. The big picture. The 10 companies on this list represent a carefully considered cross-section of the most compelling long-term opportunities in the public markets as of March 2026. 7 of them are deeply embedded in the artificial intelligence revolution. Nvidia, Broadcom, Microsoft, Amazon, Meta, Alphabet, and Taiwan Semiconductor all play critical roles in building, hosting, or enabling AI at scale. 2 of them, Berkshire Hathaway and Airbnb, offer durable compounding opportunities rooted in businesses that have proven themselves across decades and market cycles. And 1, Intuitive Surgical, represents the best of what healthcare technology investing can look like when a company builds a genuine moat. The market in March 2026 is volatile. Geopolitical concerns are real. Macroeconomic uncertainty is elevated, but volatility is not the same thing as risk for the long-term investor. Risk is paying too much for a business. Volatility is an opportunity to buy great businesses at fair or better prices. The investors who will look back on this moment with the greatest satisfaction will not be the ones who waited for clarity and calm. They will be the ones who did their research, identified the highest quality businesses available, and had the Conviction to act. The 10 stocks on this list give you a clear place to start. The rest is up to you. Disclaimer: this article is for informational and educational purposes only and does not constitute financial advice. Investing in stocks involves risk, including the possible loss of principal. Past performance does not guarantee future results. Always consult a qualified financial advisor before making investment decisions.